How do you invest and make money when real estate values are going down? I think right now is the opportunity of a lifetime. It's something that good real estate investors have more than likely been praying for to happen, especially if you're interested in investing versus doing transactional work. Now, there's a big difference between investments and transactional. An investment is something I put time or money into, and over a long duration, it pays me back and pays me more than I put into it. Where transactional is I buy low, I sell high, I make some money, but I have to do something with that money to then create cash flow because I can't live off those unless I keep working. See, the idea of passive income is money that comes in regardless if I get out of bed or not. And my definition of wealth is how many days you can go without having to work whatsoever, which means your passive income is coming in and that passive income is greater than those expenses. The longer that duration is, and if you can get to a point where you can last forever on that, that's where financial freedom really comes in. Now, that financial freedom is going to come in two parts. If you want to have a lavish lifestyle, it's going to take a lot longer to get the passive income to have that lavish lifestyle. And if you want a very, very simple lifestyle like Mr. Money Mustache that only spends $30,000 a year, it won't take quite as much, but you aren't going to have all of the thrills that you may have if you want that lavish lifestyle. What I'm saying here is it's a choice. It depends on what you want and what you're looking for. So decide what you want, make that decision, then work towards building that cash flow. But why is today so important and why is the current market so exciting for me as a real estate investor? Because we're starting to see a shift. We're seeing a shift from being a seller's market to starting to be a buyer's market. The reason why that's happening is interest rates are continuing to rise. So what strategy should you be doing right now? Let me show you. It's called the BRRRR strategy. If you're not familiar with this, it's a BRRRR, B-R-R-R, okay? What that stands for is buy, renovate, rent, and refinance. Now, the killer thing about this is right now, you have the opportunity to be very, very picky on properties that you're going to be interested in doing this in. So what I would say is don't get attached to a deal. Get out of trying to say, I need to make every single deal work and say, I want to find one really, really good deal, or I want to find two really, really good deals this year, or three, or whatever that number is. But I want to find a really, really good deal this year. Let's just say that's the case. I am going to be so picky on that deal that I'm only going to do the deal if it's really good, which gives me the negotiating power, especially as interest rates are going up. I have more negotiating power and you're having less buyers that are coming on the scene because of those interest rates. I can really go out there and negotiate and find a really good deal. Now, before I find that really good deal, what I want to do is I want to get fully approved by my hard money lender, okay? Because what I want is I want my hard money lender to give me the purchase, and I want my hard money lender to give me the rehab costs. So let's say the purchase is going to be $200,000, and let's say the rehab cost is going to be $50,000. So let's just say it's $250,000 to be into this property. What hard money lenders are going to want to make sure is that you have about 30% of equity once the property is done, once the ARV is there. So if we take $250,000 times 30%, let's get my handy dandy calculator, 250 times 0.30, $75,000. This isn't going to be a perfect science, but it's going to get you an idea, 325. So typically at 325 times 0.70 is 227. So let's say let's say this is 175, just to keep our math good. Okay, so the idea here is a hard money lender is going to want to lend you somewhere between 70 to 75% of the after repaired value of the property. So if the after repaired value of this property is 325, and you can get a loan on this property for 225, and that can cover your purchase, or let's just call it 200, and that can cover your purchase of 175 and your rehab at 50. Then you are golden because the hard money lender is going to lend you the purchase and lend you the rehab if they're the right hard money lender. Okay, then what you've got to do is that's the first step is hard money lender. The second step is to get pre-approved for takeout financing. So your hard money lender is not going to be the one that's giving you this takeout financing loan. Your hard money lender is doing a short-term loan, an opportunistic loan that's saying, hey, we'll get you some money, we'll get you some rehab money, you fix it up. But before we're going to do that, we want to make sure you're qualified through a lender to do what's called a rate and term refinance. What that means is the interest rate on your hard money loan may be 15%, it may be 18%, and your term may be 5 months. Well, a rate and term refinance goes from a 15% to 7%, and from a 6-month loan or a 5-month loan going all the way to a 30-year loan. That's called a rate and term refinance. Now, one of the great things about rate and term refinances is the cash flow and the cash that's coming from this property can then be used towards your income, which will help make your debt to income ratio even better. So you want to find your hard money lender, then you want to get pre-approved by somebody that's going to do a rate and term takeout finance, and that's going to be a bank, a credit union. You're going to want to shop around and find the very best deal that's out there and the very best interest rates. Once you're pre-approved for that, then you go out there and start finding the property. Once you find the property, then you're going to work with your hard money lender to get the purchase and the rehab. You're then going to close on that property. You're then going to rehab the property. And with your hard money lender's permission, what you're going to do is rent the property. Now, typically your hard money lender is going to say, we have to approve the tenant. The payments are going to have to come to us, but we'll credit those payments to the loan. And then you can go work on getting your refinance actually taken out. Then you'll get your refinance. And the idea with this is, if you can refinance this property for the full $200,000, which kind of cool, if you have $200,000 and it's worth $325,000, you're going to have a much easier time refinancing this property because there's equity in this property, even if we're in a declining market. Okay. Now, here's the kicker. Interest rates are really high right now. Oh no, what do I do? Well, what I want to make sure, when I look at historical, I'm seeing rents go down somewhere between 5 to 10% in a really bad market like a 2008. I don't think we're going to see that again, but let's talk a little bit about rents over time and pull up. Okay, so this is rents over time over the last, 80 years, 75 years, something like that. So you can see rents go up in value. It just goes up. You see it was pretty steady here and it's starting to slow down a little bit, but it's just going up. What I want to point out to you is from 2005 to 2010, which is when we had the 2008 financial crisis, real estate crisis, rents actually went up. Let's take a look at this. If we look at 2005 to 2010, rents jumped on the average from 694 to 810. Now, I will tell you, I did see rents go down a little bit right when that 2008 crash started to happen. I think on average, you see rents going down 5%. If you want to be conservative, plan on 10%. I don't think you're going to see them like that, but I don't have a crystal ball. But the point is even after that, in 2008, 2009, rents just continued to go up. Okay, so here's what we're going to do. This is why it's such a great opportunity. We are going to make sure that our payment on this loan covers all of our expenses and gives us a 5 to 10% cushion on all of this. So I got to change colors here because I'm getting so excited. Okay, so let's go get pre-approved for that loan. We need that loan for $200,000. So what you're going to have on that loan is you're going to have, let's get somewhere you're going to have a few things. You're going to have principal, you're going to have interest, you're going to have taxes, and you're going to have insurance. PITI is what it is called. Now let's just jump on and grab a mortgage calculator and show you what a payment would look like. Okay, I'm just using a simple calculator on here. Doesn't mean these interest rates are right or anything else. You're gonna wanna check all this out. I'm using this simply for math, okay? So let's say that we are buying the property for, actually we should do a refinance. So our mortgage is gonna be for $200,000, right? And we are gonna get a 30-year term loan. And right now, let's just say the interest rate, so let's say rates are at 7%, just to put that in there. Let's say annual property taxes are about $1,500. And let's say average insurance is about $400 per year. Now this is gonna be different depending upon where you're at and what you do, but this will give you an idea. That means my payment on this would be $1,100 $488 based upon a that's a monthly AM, based upon my taxes, my insurance. Let's just call it $1,500, okay? Let's just call it $1,500. So let's say my principal, my interest, my taxes, insurance, all of that equals $1,500. Now, what I want to do is create some buffer. So I'm going to want to make sure that I can rent that property for 5 to 10% more. Now, if I can rent it for more, that's great, but I want to be 5 to 10% more. So that means I'm going to want to be somewhere around $1,650 would be 10. And if I want to go for 5%, I'm talking about, what is that? $1,575, I think. So that's what I'm going to want to look at, somewhere in there, $1,575 to $1,650. I want to make sure I can rent it for that. But wait a minute, I also want to make sure I'm the best deal out there. So I want to add another 5 to 10% so I can rent the property for less than what market rents actually are. Let's get some room here so I can show you exactly what I mean by that. Okay, let's recap. Our payment is about $1,500 a month for this house. That's at about a 7% interest rate is what we said. The loan is for $200,000 and we say the value is somewhere between let's say 325 and 350, okay? So this is the loan. This is the value, and keep in mind, you put very little money into this, right? Because you bought a great enough deal that your hard money lender funded both your purchase and your rehab as long as it was under 70 to 75% of the after repaired value, okay? Then what we're saying, hey, we want to make sure our $1,500 is how much our principal, interest, taxes, and insurance is. That's how much all those things are. Well, we want to give ourselves a little bit of a buffer. So let's say we give ourselves a 5% buffer, and that is to make sure if rents go down. Okay, you can do a 10% if you want to. I think 5% is pretty good. So what I'm going to do is 1,500 times 0.05, that's $75. So I'm going to add $75. The other thing that I'm going to say is, I want to under rent my property. So I'm going to add another 5% on that, 5 to 10% on that. And let's just call that another $75. Okay, so now I'm at 75 plus 75 plus 1,500. So basically, I want to make sure that rents in the area are $1,650. You know, solid rents in that area are $1,650, okay? If solid rents in that area are $1,650, then I'm gonna rent the property for $1,600 or $1,575. Now, if you want to actually make some money along the way with this, you can increase that as well, and that would be your margin, but I'm okay with you just breaking even on this deal the way that we have it structured. So if the rents don't go down, you're gonna be making $75 a month. You are gonna give this discount because you wanna have somebody living there for a long term. So let's just say that you're going to rent the property for, let's just say you rent it for $1,600 a month, okay? $1,600 a month, you're going to make $100, which is the difference between these two, but you are going to have to be prepared to take care of some repairs. The good news is you just rehab the property and spent $50,000 in that, so there shouldn't be capital improvements. They're going to have to get done to the property. What we're talking about is more minor repairs, but you are going to need some money for that, and you're going to need some money if you have some vacancy. But if you under rent your property, that vacancy should be very insignificant, but you may have to make a few payments from time to time. And so you've got to be prepared for that. And you're going to say, well, Ryan, how the heck do I make money with this? Here we go. What's going to happen over time here is eventually interest rates are going to come down. So we're going to buy the market. We're going to buy, say, once a year or twice a year as the market's coming down. So maybe properties are worth 300 and then they're worth 275 and then they're worth 250. So as that market comes down, we're going to keep buying those properties. Now, what if interest rates go up? No problem. We're going to get a 30-year fixed rate. We're going to make sure that the deal pencils, which means that once I add on the rents going down and being 5% down, I want to make sure that the rents in that area justify that, so I can be under it and I can have myself some room if I have to lower my rents. Then you're saying, well, I'm not making any money. This is how it works. What you'll eventually see as you're seeing values go down, you're going to see the Federal Reserve do something they do all the time. They did it during COVID, they did it during 2008, and that is they start to lower interest rates again. So if interest rates go from a 7% to a 3%, which you're going to see happen one of these days, you are going to save yourself a grundle of money, and that is where it gets serious because two things are going to happen. One is property values are gonna start going up again. And two, you're gonna be able to cash flow this thing. Now, the great thing about this is, let's say it takes 2, 3, 4, 5 years to do that. You have paid down this loan considerably, or better put, your tenant has paid down this loan considerably. So I'm gonna say right now, you only owe $175,000 on it because your tenant's been paying that down. And we're gonna see interest rates got down to 3.5%. Well, look what that does. Now your payment on this property is $945. You get a 30-year fixed. It's fixed for 3.5% for 30 years. It's $945. Well, let's jump back over here and show you what type of money you're actually going to be making, okay? So $945 is your payment. You're renting that property for $1,600 a month, even though it could be $1,650. Rents are going back up because rents typically do over time. You're even able to raise rents now because it's a few years later, so maybe it's $1,700, and all of a sudden you're making $750 a month cash flow because you were willing to play the strategy. So what is the strategy? It's the BRRRR technique, locking in an interest rate now, waiting for interest rates to come down, buying properties as the market goes down, refinancing that once interest rates start going down, and then holding on to it for cash flow. I cannot see a better opportunity in today's market than doing this BRRRR type strategy and holding the property and waiting for the refinance. This is what you've got to do, but you've got to have a long-term perspective on this. Now, if you want to know how hard money lending can help you through this entire process and what you need to do, check out this video on why hard money lending is the backbone of doing these types of deals. Why hard money lending comes before your property, why every deal should be the same, and you've got to get funding through a hard money lender, what you should be looking for. Check out this video and make it a very profitable day.